let's talk about gold. For literally thousands of years, it's been the ultimate symbol of wealth and security. And today, there's one company that stands head and shoulders above everyone else in the race to pull it from the ground. We are talking about Newmont, the undisputed king of gold mining. But, being a giant is never easy, and Newmont has just been through an absolutely massive transformation.
So what if being the biggest isn't actually the best? We're about to dive into the incredible story of how the world's largest gold miner, right after a huge acquisition, did something that shocked a lot of people. They decided the real path to winning was to actually get smaller. It's a fascinating look at corporate strategy, so let's just start with the mind-boggling scale of this operation.
To really get your head around that scale, just imagine this. If you took all the gold Newmont expects to produce this year, melted it into those standard gold bars, and laid them end to end, they would stretch for the length of 33 football fields. That's the kind of giant we're dealing with here.
And that scale? Well, it really puts Newmont in a league of its own. I mean, just look at the resume here. Newmont isn't just the biggest gold miner on the planet, it's the only one that's in the S&P 500. That's a huge sign of stability and trust from the market. And that 5.6 million ounce forecast, it's just a staggering amount of precious metal.
Okay, this is where the story gets really interesting. So, Newmont had the crown, right? They were the world's largest. But the market wasn't buying it. The company was so huge and sprawling that its true value felt hidden, and its stock price just wasn't reflecting its potential. Being big simply wasn't enough. So management made a very bold move. They kicked off what they called the Great Streamlining, a plan not just to trim a little here and there, but to fundamentally reshape the entire company and unlock all that value they believed was trapped inside.
Their strategy was a super decisive three-step play. First, they decided to focus only on their absolute best top-tier assets. Second, they made the tough call to get rid of everything else, selling off 6 entire operations and 2 big projects. The goal of this radical diet was simple: generate a massive pile of cash.
And wow, did it work. The asset sales quickly brought in a whopping $3.8 billion in cash. This was the fuel they needed to completely supercharge their finances. So, here's the critical question. Did this bold plan actually work? I mean, did selling off huge chunks of the company really make the whole thing stronger? Well, the numbers that came next were frankly spectacular. Let's look at the payoff. Now, before we see the next number, it's really important to understand this term, free cash flow. Just think of it like this. It's the pure, cold, hard cash a company has left over after paying all its bills and investing in its own business. It's one of the best signs of a company's real financial health.
The result was just mind-blowing. The new, leaner Newmont generated a record-breaking $1.7 billion in free cash flow in its latest quarter. To put that in perspective, that's nearly triple the amount from just 1 year earlier. The strategy wasn't just working, it was working incredibly fast.
And the company put that cash to use right away. They got super aggressive about paying down their debt, slashing it by an incredible $5 billion. Their net debt just plummeted from $6.4 billion at the end of last year to only $1.4 billion today. That is a dramatic improvement.
And, as if to send a giant signal of confidence to the market, the board also authorized another $3 billion for buying back its own shares. That's a direct way of saying to investors, we believe our own stock is a fantastic investment right now. So all of this success leads us to a really surprising twist. The company's stock might actually be a bargain. Yep, despite this incredible turnaround, several key metrics suggest Newmont is currently undervalued by the market. So, first up is the price-to-earnings ratio, or PE. It's a really simple way to see how much investors are willing to pay for each dollar of a company's profits. Generally, a lower PE, especially compared to rivals, can be a big sign that a stock is on sale.
And that is exactly what we see here. Newmont is trading at a PE ratio of just 13. Now, compare that to one of its main competitors, Agnico Eagle Mines, which trades at a multiple of 18. That's a pretty significant discount for the biggest gold miner in the world.
And get this, it doesn't just look cheap compared to other companies, it looks cheap compared to itself.
Using another metric, we can see that today, Newmont trades at just 0.7 times its net asset value. That is way below its historical average of 1.0 and less than half of where it peaked back in 2022.
And you know what? The experts on Wall Street are really starting to take notice. Carrie McCrory, an analyst at Canaccord Genuity, praised the company's recent performance, pointing to that robust cash generation we just talked about as the key to their strong results.
And that same analyst didn't just talk the talk. He gave Newmont a buy rating and set an $86 price target. Now, at the time the article was written, that suggests the potential upside of 24% for the stock. Not too shabby.
So, what does this all mean for you? Let's tie it all together and boil it down to the key takeaways from Newmont's amazing transformation. Why does this story really matter?
Okay, so let's put the final investment case together. You have the world's #1 miner operating in a strong market for gold. Its huge corporate overhaul is clearly working, and it's generating record amounts of cash. Its balance sheet is getting healthier by the day, and the final piece of the puzzle? Despite all that good news, the stock still looks like it's trading at a serious discount. Which, of course, leaves us with one powerful final question. After this remarkable transformation that turned a lumbering giant into a lean, mean, cash-generating machine, is Newmont perfectly positioned to finally hit pay dirt for its investors? The evidence we've just walked through certainly suggests it might be time to take a much closer look.